Federal investigators are examining whether insurance companies Delaware Life and Clear Springs Life and Annuity, controlled by billionaire Mark Walter, used billions of dollars of policyholders-backed assets to finance other businesses connected to Mark Walter, while failing to properly disclose those transactions as related party or affiliated investments. My guest, Tom Gober, is a forensic accountant and certified fraud examiner who's looking at essentially the same structure back in 2014 and has been warning the public for the last 12 years about this. And Tom, pretty much what made me reach out to you is I saw this headline: Delaware Life previously reported roughly 1.4 billion of affiliated investments, which I know you'll break that down for us. But after subpoena triggered an internal review, that number was a little bit off. That number was reportedly revised to more than 17 billion. So that's a difference between 3% of invested assets to closer to 40%. And that's a staggering difference. I had to sit down with you, where you were actually in my home, and we broke down your background. And so if anyone's interested in learning about your background and all, they can check that out. But I just wanted to bring you on here and see like what's going on. It's my understanding that you were one of the people behind the original like complaint and bringing like helping this get in the public's eye. And so I just wanted to bring the expert himself to explain what's happening here.
I'm happy to be here. I love speaking with you guys. You've got a class act crew.
Okay, so what's going on here? Like, if you can just break this down, maybe for the person that doesn't even
Sure.
know what like an affiliated investment is, why insurance companies even matter. Maybe you can just give a little bit of the history, but then let's
Sure.
go into like why is now everybody talking about this?
Well, first of all, when a holding company owns a life insurance company, if the holding company is run by traditional executives who've run mutuals their whole career, I don't worry as much about affiliated investments. But when private equity is at the top, it's my experience that they cause the policyholder funds to be invested in things that are often higher risk and less liquid. But what worries me the most is where the policyholder funds are used to purchase upstream, what I call affiliated paper. It might be notes, they might call them bonds, but the money is going upstream. And the problem with that is it's fine if you don't do too much, as long as it's reasonable amount. I like to say no more than 50% of surplus, the lesser of 50% of surplus and 10% of invested assets. In almost all instances, what we want to look at is 50% of surplus. And in this case, they're way over that, obviously.
And surplus is insurance accounting for profit or
It
money
looks
left.
like equity. It's the excess of assets over liabilities. So everything they owe, all those death claims and promises through annuities, to the extent assets exceed those liabilities, you have surplus. And by law, you have to have a positive surplus in a life insurance company. So the problem is if the insurance company becomes what we call the cash cow, you follow me? If the insurance company is sending a lot of money upstream for investments, for reinsurance, affiliated reinsurance, for management and service fees, there's all kinds of ways that money flows upward. So think about that. If the insurance company came under a stress event and the regulator had to say, I better put this in receivership and get my arms around it, protect policyholder funds. Well, think about that. If you've invested 17 billion upstream and those companies are clearly, I would say, almost addicted to the funds flowing up from the insurance, because remember, policyholder premiums pour in 365 days a year. So if they're used to being fed from the cash cow down below, if there's a problem with the cash cow, Imagine all of those investments with companies that not only are affiliated, but have become dependent on the cash cow. So if suddenly the cash cow has a problem, it is historically a fact that the affiliated paper will plummet much faster and much deeper than investments you could go and sell in the marketplace, right? So it's internal paper. Does that make sense?
Yeah, it makes a lot of sense. In our interview that we did, you sat down and really broke down some of the concerns that you had. We didn't even talk about these insurance companies by name, but you really were sounding the alarm. This is something that you've been talking about for a while now. Is the big issue, like there's a couple issues, but I've been seeing things in the news allegedly where they're almost comparing this to like Bernie Madoff, where you're getting people who are putting money into these insurance companies with the idea that this is the one of the safest parts of their portfolio,
Right.
and they're being promised something. And I would assume that they're getting paid, just like every good Ponzi scheme starts. Everyone gets paid, everyone's happy. But the issue is there's very strict regulations on how this money needs to be invested and
That's
how
right.
it can be invested. And maybe 3% of invested assets doesn't turn any heads, but 40% into something. And again, Mark Walter, I'm not saying that this is the money that was being used. That's one of the reasons I'm bringing you on, but he's part owner of the Lakers that he just
Right.
purchased and allegedly got out of, the Dodgers. Like these are assets that are are pretty amazing, but they're not what you call super liquid. And so I'm just wondering like what's going on there, because there's a lot of red flags. If you have one person that's owning these insurance companies and also benefiting from but allegedly up to 40% of that, who's negotiating to make sure that the insurance company is getting the right deal? Or is it one of those things where you're getting these insurance companies, wink wink, to just strip money out in a very favorable way and hope that nobody notices? It seems from me on the outside that there's a lot of shenanigans going on, because you don't just have a couple $1 billion error. Like this is not the US government that's, $1 trillion plus in debt, that's just cranking every year.
I think I can help you. I think I can
Yeah,
help you with that.
yeah, please help me
So,
understand this. And then I also, Tom, would love to know like what got you involved in this 14 years ago.
sure,
I think that's interesting as well.
sure. So let's back up just a minute. I believe that most policyholders imagine that at their big life and annuity company, it's been around decades, that the management is investing traditionally and prudently, right? That's what I would have expected. Until more recently, a lot of companies, especially if they've been taken over by private equity or other aggressive investment firms who have different objectives from what the traditional executive would have. The traditional executive would say, we need to invest carefully to make sure we have the money. But the statute says you have to have enough money right now, but you also have to have enough money 90 years from now. Life insurance policies, people pay for their child at birth. So you could be looking at 100 years, right? So we have to have rules. One of the most important rules is not too much affiliated paper. Well, you would think that that shouldn't happen anyway. But in my professional opinion, the way the private equity groups have caused the insurers from inception, the moment they take control, they require the insurance company to sign an investment management agreement that says the parent is going to make the investment decisions. So imagine if private equity takes control of this company and they have total say on how the money's invested. There's a temptation to invest in things that they're connected with, right? That's the reason we need to know. And let me say this: there's nothing wrong with investing in affiliated paper up to a reasonable amount. What's bad is when you hide the fact that something is affiliated when you know it is affiliated. Because what statutory accounting says is that if someone invests, if a company has a major transaction with an affiliate, we have to know that, because it's not like two independent parties. If two independent parties with their own money and they're sophisticated, we can presume that's arm's length, fair and reasonable. But if it is between two parties under common control, then we cannot presume that. And in fact, statutory accounting says that's where you need to apply additional scrutiny to make sure it's fair and reasonable. Because I've used this example before, but if Mark Walter is in Kansas and he calls Mark Walter in the Cayman Islands, he could negotiate just about any terms, right? I mean, seriously, that's what common control is about. So it's not just that you need to limit how much you invest in affiliated paper. It shouldn't be a conflict of interest. And you start wondering when you end up with 17 billion, 21 billion, the whole group, north of 20 billion. When you see that, you've got to wonder if some of those investments were more to the benefit of the investor, Mark Walter and other investors, and maybe even to the detriment of the policyholders. So what I'm trying to emphasize is that because private equity is, we all know private equity is not like the old traditional mutual insurance company. They like profits, they like strong earnings, and they want things quicker, right? So does that help some?
Yes. I have two questions. And if you can't answer these, because I know that you're involved, and so I don't want to get you in trouble in answering anything that
Okay,
you
I'll be
shouldn't be
careful.
answering. Question number one, was any Cayman Island stuff going on to make this thing happen? Or is it just, in your opinion, just purely I'll say it, fraudulent from an accounting standpoint, like just lying, straight up lying?
Yeah, I can't say fraudulent. I haven't investigated the source documents. But yeah, there's a lot of Cayman Island involvement, both holding companies, reinsurers, across a group of companies that seem to be very much affiliated with the Mark
So,
Walter
so you're
group.
saying that could be the way that they flowed a ton of money. When we sat and did our in-person interview, you talked about how other companies would use Caymans to almost like, hey, you got a lot of scrutiny in the States. Boom, we're gonna send money to the Caymans, and now we skirt a lot of the same regulations. So it's kind of like a loophole. It's like, hey, do I want more regulation or less? I'm going to send my money to the Caymans, have less. You're saying that this same thing that you and I talked about a while back could have been the same mechanism that this happened.
There is definitely sleight of hand reinsurance. That's what we've
Okay.
talked about, where it's done with affiliates and it's done in black boxes in the Caymans, Bermuda, Vermont,
Yep.
wherever the captive is, so that we can't confirm that they're money good, right? And
Right.
so if they send 10 billion in liabilities, but only send 5 billion in assets, that creates an appearance of 5 billion in surplus. And that would enable you to invest more in affiliated paper without it freaking people out, because you keep fluffing everything up. It's easier to get away with investing in affiliated paper. Does that
My,
make sense?
yeah, that makes sense. My next question is, even if we take Mark Walter out of this and his potentially flashy investments, even if I'm trying to put myself in the shoes of an insurer, like if we're talking in this one case, 40% of their assets in any one investment outside of like US treasuries, it's hard for me, like, what kind of regulations are there when it comes to even that? Because I'm even like, let's take Mark over to the side, because he could potentially argue to say, hey, all my investments have gone straight up. This is like best thing in the world. But from a risk standpoint, it's kind of like I have more diversification in my personal wealth than
No
what
doubt.
it seemed here. And so am I crazy for asking that?
Not at all. And let me put it in perspective. Do you remember the Greg Lindberg matter?
I couldn't speak confidently about it.
In North Carolina, he's in prison. He got in trouble under corruption laws for paying money to a commissioner to get special treatment. And the treatment he was seeking was North Carolina limited in affiliated investments to 10%. So that's all you can do, 10% of invested assets. Somehow they agreed to allow him to go to 40. And it's that extra 30 that ended up being a huge problem. It's how a lot of money went out and couldn't come back. Okay. So, yeah, 40% is way too high. Again, 50% of surplus is the safe way to go. But it's also, you mentioned earlier liquidity. I'm glad the Dodgers team has done well, and I'm glad it increased in value. The problem is the money that the policyholders made available to originally purchase the Dodgers was in the form of a debt instrument, like a bond, or it was a loan.
Yeah.
So if the value of the Dodgers skyrockets, which it has, the policyholders don't get to share in that benefit, even though their money was at risk from the beginning,
Yep.
right? So
Yep.
to me, that looks like a conflict of interest.
Yep. That you get to hold the risk, and yet you don't get the upside.
Right.
And hence why, this is not the only situation that's happening. This is becoming the most public. What is your, I question about the person that went to jail. Did that person go to jail because he paid off the commissioner, or did he go to jail because of the difference between 10% and 30% difference? Like, what actually got him thrown in jail? And did the commissioner who allegedly took a bribe, did he get in trouble as well?
No, the commissioner, as I remember it, cooperated. What I do know is that the first investigation and indictment and conviction was under corruption related to paying the commissioner. The later trial was on financial accounting fraud on the insurance companies that he had taken the money from. Does that
Okay.
make sense?
Yes,
And
that
he
does.
ended up convicted under two different mechanisms. Okay. And you also asked though about 2014, right?
Yeah.
Uh, Back in around 2013, when I was reading that Mark Walter had purchased the Dodgers, it sounded like he was purchasing the Dodgers all with his money. So I just looked to see if the insurance company might have funded some of that. And what I found was that it looked like they had, but it wasn't disclosed. It wasn't like, hey, I'm going to use some of the policyholder money to invest in the Dodgers. It was just affiliated investments. It was just, money going to an affiliate. But then from there, it goes on to buy the Dodgers. So I got together with some really sharp lawyers, and we put together a case and we filed it, and it settled quickly. My clients were pleased. Um, but now, 12 years later, I hear that the feds are investigating what seems to be the same problem, because what we wrote about in the 2014 complaint has to do with pretending something is not affiliated when in fact it is. A misrepresentation related to affiliation. And that might be investments, it might be reinsurance. But if it's a material transaction and you're in control on both ends, we need to know that, and we couldn't see that. That's what the feds are investigating today. So what bothers me is it seems like nobody did anything in that interim 12 years. The complaint is public, and the state, I never heard that the states investigated or limited any of this. It took the feds to bring it out, and I'm proud of them for doing it because somebody needed to speak up.
Yep. What, Tom, from someone who's got the history like yours, what are you looking at right now? And what are you going to continue to look at in the news? My next question is, if you're a policyholder watching this, what should be going through your head? But I'm just curious from your standpoint. You don't have to make any predictions, but what are the things have not come out that you're waiting to come out right now?
Well, you and I've talked about this before. I do a lot of deep dive risk analysis on all of the carriers, the life and annuity carriers. And there is a hefty group of these carriers that are very aggressive. They're aggressive in their investing in higher risk, less liquid investments. They are reinsuring with affiliates where you cannot see it, either offshore and a captive in the US. They are investing in each other's paper, not just high risk assets, but affiliated paper. They're even, a lot of them are guaranteeing affiliates. So you've got all of these things happening inside what they call the holding company system, from the top all the way down, and the insurance companies down here. Within that holding company system, what has happened is a lot of the aggressive carriers have what I call excessive interdependence within the group. So if you're loaning to affiliates, if you're investing in affiliates, if you're paying management and service fees up to affiliates, you're guaranteeing affiliates, you're building a structure that is fragile, but you don't see that it's fragile. And what I said earlier about all this money going up, if suddenly something happens to this company, it's trouble up, right? It's trouble. And so I believe there is a strong need for additional regulatory scrutiny in affiliated transactions. There should have been all along. The examiner's handbook, the NAIC examiner's handbook, is outstanding. I have it. It's all highlighted. I've used it for years. It's crystal clear. It says if it's a material transaction with an affiliate, you've got to anticipate it could be used for self-dealing. It literally says that in the handbook. Watch for self-dealing. But we don't know to watch for self-dealing if we don't know that a transaction is affiliated in the first place. And there's also a lot of affiliated reinsurance. So I think the two biggest concerns for me with the affiliated mechanism, the affiliated systems and interconnectedness between multiple systems, is along the investments channel and the reinsurance channel. Those are the two that I'm most concerned about. What I would suggest is that policyholders that are looking to purchase perhaps a life or annuity product, if the agent suggests a given company, XYZ Life, you should ask the company to provide you with how much that company cedes offshore and to U.S. domicile captives where you can't see the other end. Ask for that, and then ask them to also show you the total surplus. And if they're doing a lot of offshore stuff, I would stay away from them. We can't, not because I know it's bad, I just know it's not compliant. By law, they're supposed to show us the other end. So anyway.
Yeah. And while you don't work with individuals, if you are someone watching this and are like very interested in Tom's work, I know you do consulting. I know you speak. You spoke at my event. I said when you came on my show for the first time, I said they're going to make a movie about your life, and this is unfortunately going to be potentially part of it, as this is a lot of people are becoming insurance experts on reinsurance and private credit overnight, and but it's interesting to see that maybe something like this will make people be aware. Hopefully,
Yeah.
it will make certain companies pump the brakes and be very careful, because um, it's very concerning for me that these solid companies would be pretty much allowing other institutions to take all unlimited upside
Right.
with them taking the brunt of the risk. I think it's unacceptable, and
Yeah.
let's hope that let's hope that it gets turned around. Do you have any predictions on what's going to happen?
Well, um, we've talked, and it's too complex to go into now, but we've talked before about funding agreements, funding agreement back notes. They used to be called GICs, guaranteed interest contracts. There's a lot of that is a type of short-term debt. And there is a lot of that in some of the more aggressive companies. Some companies have 70 billion in short-term debt and maybe only 8 billion in short-term investments. So if there's a sudden demand for liquidity or they quit rolling into the next funding agreement, there could be some real liquidity stress. And I think that is what worries me the most.
Yep. If you are a policyholder for one of these insurance companies, are you in the panic state right now, or do you like, hey, it's all going to get its worked out? Like, at this point, is there a pretty high likelihood that because this is getting caught, because Mark owns other entities that seem to be doing just fine, that it's all going to work itself out, and then whether how he gets in trouble, whether it's a slap on the wrist or other things, is kind of working itself out? Or would you say something like, "Hey, if you have a policy with one of these companies, you better talk to a financial professional immediately about your options"? Where are you at right now? I know you got to be careful. I know you don't want to be saying fire in a movie theater,
I
but
don't.
it's
I don't.
it's it's I mean, this is in some cases people's retirement pension or their retirement, and so when you're hearing something like
Serious
this,
business, yeah.
and I'm not even trying to get a sympathy like you're gonna be fine. I just want to know from like someone who's in it more than anyone I know, like what would you tell them if they were sitting across the table from you and saying, "Tom, what should I do?"
I'm gonna say the exact same thing I've been saying for years. There is an absolute lack of transparency in these balance sheets. Not the strong traditional mutuals like a New York Life or a Guardian. Well, they are owned by their members, the policyholders. But when you have private equity controlling these life and annuity carriers, for some reason, they're doing a lot of stuff where we can't see it. And we're supposed to be able to see it. And I've screamed about it so much. It's a shame that it takes the feds to call it out. But since they have, what I'm hoping is that the state regulators will increase scrutiny. I don't know what else to say. I've been
Okay.
saying I'm worried because there is not transparency where there's supposed to be. You know, it seems to me they could just the regulators in the state in the US could say to the company in the US, you're sending billions in policyholder promises to the Caymans, but it's your affiliate.
Right.
So you need to require your affiliate to file on an annual statement form under statutory accounting.
Yeah.
That would suddenly we would find out, is there a big hole or is it okay? My
Yep.
concern is there are big holes, and
Yep.
I wish somebody would prove me otherwise.
And here's what I'll say. This is coming from me. If you are a policyholder with one of these companies, or just in general, and you want to talk to a financial professional to see like what's going on, look at your options, we'll have a link down below. And Tom, I look forward to staying updated on this case with you. Thank you so much for the work that you've done. It's you're in a very depressing space, and yet you're making our industry better. even though there's
Right.
going to be some growing pains and some frustrations.
Yep.
Stuff like this actually is a good thing that it's being exposed. And so for that, thank you. We'll have your information to your website down below. And until next time, thank you. I know you're very busy, and I'm very grateful that you took time to be on the show and just share a little bit what's going on. And um, any final words before you hop?
Only that, Caleb, I spoke to a large group of your people, 500 people or so, and I could tell that they drank your Kool-Aid. They believe in only putting a policyholder in a product with a company that is going to outlive the client. If your insurer dies before your client, it's going to be ugly and painful, right? But all of your group, and it spoke with a bunch of them, and they all were like, we almost totally invest in mutuals. And so I wish more advisors would take that stance.
I
I
think
like
it's
it
we're gonna
here.
see. I think we're gonna see a direction, and it's hopefully financial professionals looking less on like who's gonna pay me more, and more of like, hey, what's gonna be something that I can sleep well at night, and
Right.
hopefully the incentive goes to the companies that have been doing the right thing from the very beginning. Tom,
Thank you
thank
so
you.
much. It's always a privilege.